All right, good morning. Welcome, everyone. Thank you for joining us for our webinar today, Top Financial Statement Errors and How to Avoid Them. I'm Ellen Sukup. I'm an Audit Senior Manager here with Sikich, and I'm part of a larger team who specializes in the not-for-profit industry. Sikich, as a firm, we host many webinars, several a year, on topics that are relevant and up and coming for the not-for-profit industry. I know that several of you have joined these before, so welcome back. And if this is your first time joining us, thanks for coming today. Hope you enjoy the presentation. Sikich is a professional services firm supporting not-for-profit organizations through our audit, tax, accounting, advisory, and technology solutions. As you can see in the last graphic, we offer a lot more than just CPA services. We have an award-winning technology practice and a robust advisory practice, among other things. Our team serves a variety of not-for-profit organizations, including higher education institutions, social service agencies, healthcare organizations, foundations, and more to help support your mission. We have a team of our employees and clients across the US and internationally, and we really enjoy being able to connect with all of you here today virtually. So thank you for joining wherever you are joining from. And next, we will do our introductions. Let's meet our presenter. Today, we have Jennifer Kasakia, who will be giving our presentation and who is an expert and a director here at Sikich in the not-for-profit industry.
Thanks, Ellen. Thank you all for attending. I'm going to talk a little bit today about how to spot common errors in not-for-profit financial statements. This allows you to improve your decision-making based on accurate financial statement information and also to increase the reliability of information for financial statement readers. The agenda today, I'm going to cover things fairly quickly because there's a lot of material to pack into a 1-hour presentation, but I'll try and touch on highlights of common errors seen in the statement of financial position, the statement of activities. I may refer to the analysis of expenses by nature and function as the statement of functional expenses. And I will also talk about some things on the statement of cash flows and the notes to the financial statements, as well as an overall review. So I'd like to jump in with the statement of financial position. Just keep in mind with all of these common errors, a lot of these things aren't new, but rather they may be things that are new to the organization, and that may lead to some common errors when we're not always thinking about all of the requirements, the existing requirements for things that are new. But one of the common or the overall concepts in the statement of financial position is emphasis on liquidity. So here's what FASB has to say about liquidity. It says information about liquidity should be provided by any of the following. So either sequencing assets according to their nearness of a conversion to cash, and sequencing liabilities according to the nearness of the maturity and resulting use of cash, or presenting a classified statement of financial position where the assets and liabilities are separated into current and non-current, or disclosing or disclosing into the notes to the financial statements any additional relevant information about the liquidity or maturity of assets and liabilities, which would include restrictions on the use of particular assets. So here are some factors that are affecting liquidity. The one you most commonly think of are donor restrictions that might affect liquidity. So there may be donors restrictions on assets to purchase endowments or for the purchase of long-lived assets. But other things beyond donor-imposed restrictions may also affect liquidity. Those could be your board designations, perhaps for quasi-endowment funds or other reserves for special purposes. And then there may also be some legal and contractual restrictions, for instance, sinking funds for retirement of debt. So it's not just the donor restrictions that affect liquidity. It could also be these board designations or legal and contractual restrictions. And one of the main places this plays out is in the area of cash and investments. Oftentimes, if you're going to have restrictions on the use of particular assets that affect liquidity, it's going to be in this cash and investments area. So FASB has some specific examples of things that should be considered in the nature of whether those items are more liquid or not. And the first one is cash and cash equivalents of perpetual endowment funds. So for organizations that have endowments, sometimes cash and cash equivalents are held within the investment portfolio until suitable long-term investments are identified for purchase. That cash that's held as part of a not-for-profit's endowment should be segregated and moved lower down the section of assets on the statement of financial position, less liquidity, and not included on that line, that top line of cash available for operations. So any cash held as part of the endowment should be separated and not shown as part of your operating cash. Likewise, cash and cash equivalents that are restricted by donors to be invested in land, building, and equipment should not be included in your operating cash. Again, that needs to be segregated, and most likely that cash will be presented very close in order of liquidity with your property and equipment. Investments of endowment funds and split interest agreements should not be combined with your operating investments. Again, those need to be segregated and moved down in the order of liquidity. So investments of your endowment funds are probably going to be towards the bottom with perpetual interests and trusts, perhaps other things of a more permanent nature. And likewise, board designated amounts should be segregated. So if you have investments or cash and investments that the board has designated for long-term purposes, those also should not be part of your operating cash and investments, should be segregated and moved down in the order of liquidity. So here's a sequencing example that's present in the actual codification. This is the codification example you can find, and you'll see that the cash and cash equivalents on that top line, that would represent the operating cash. And then as you move down the statement of financial position, things should be appearing less liquid as you move down the asset section and the liability section. So in this example, assets restricted to investment in land, buildings, and equipment has been segregated from the operating cash or the operating investments and presented lower in the order of liquidity right by land, buildings, and equipment. Likewise, if you look at the liabilities section, you're going to see long-term debt is further down than accounts payable, which would be expected to be a nearer conversion to cash to use to pay for those liabilities. Another area where we see some common errors is in receivables and their presentation in the statement of financial position. Now that we have Topic 606 implemented for all not-for-profit organizations, we want to make sure that we're separating receivables in the statement of financial position in two. So we want to be presenting receivables under ASC 605 or contributions receivable separately from your trade and other receivables under Topic 606. And I want to talk a little bit more about your receivables under ASC 605 or those contributions receivable. I've put, they're sometimes presented in several different names. So either promises to give, contributions receivable, grants receivable, pledges receivable. So we're talking about all of those receivables under 605. Where we get into trouble and see some common errors is not only in the presentation, but the underlying accounting for the contributions receivable. Sometimes that underlying accounting isn't correct, and that leads to errors then in the financial statements. So the first thing to remember is for contributions receivable, we want to make sure that we're recognizing them only if it's an unconditional promise to give. So a legally enforceable unconditional promise to give. Intentions and conditional contributions aren't recognized. So for instance, an intention to give might be a donor has named the not-for-profit organization in their will. That's still an intention to give and not something that can be recorded at that point, because during the donor's lifetime, they could still change their will. The promise to give, or the contribution receivable, would not be recorded until after the donor's death, when the will has cleared probate and is no longer contested. So when the not-for-profit gets notified that the will has cleared probate and they have a likely amount that's been communicated to them to record, at that time they could record the promise to give. Likewise, for conditional contributions, if you recall, ASU 2018-08 changed the model how conditional contributions are recognized. There's no longer a probability assessment on determining whether a contribution is conditional or not. Now we've moved to a barrier and a right of return or release from a promise. So if there's a barrier to entitlement of the funds, the not-for-profit is not to recognize the conditional contribution until that barrier has been overcome. So just a reminder there. Now, if the donor has advanced the funds to the not-for-profit before that barrier to entitlement has been met, it should be recorded as a refundable advance. Often these could be refundable grant advances, for instance, on the statement of financial position, if they receive the payment before that being entitled to the funds. One area where we see in practice, this is identified primarily in the footnotes. If you have a footnote that is talking about contributed use of facilities, donated space, below market rent, and the footnote indicates that the not-for-profit is receiving below or market rent or free rent in a period excess of 1 year, there should be a contribution receivable for that contributed use or free use of facilities. So this often gets picked up when you're reviewing the notes and you see that there's a long-term agreement with a donor. Where's the receivable for that free use of facilities? So those should be measured just like other long-term promises to give or current promises to give. So our measurement here, if the contribution is receivable within 1 year, it's measured at net realizable value. And if it's 1 year or more, it's measured at fair value. And present value techniques are typically used to determine fair value for those long-term promises to give. One other area that's sometimes missed with promises to give or contributions receivable, there's generally an implied time restriction. So promises to give that are due in future periods have that implied time restriction, and those time restrictions generally lapse as the promises become due. So don't forget to include promises to give with future due dates in your net assets with donor restrictions. From the liability standpoint, we don't see as many hang-ups with liabilities or errors that are being made. However, they generally come about if there's new circumstances. So for instance, the not-for-profit hasn't had debt in a while, got new debt since the standard had changed, requiring the debt issuance cost to be netted with the carrying amount on the debt on the statement of financial position. Sometimes this gets made. So debt issuance costs need to be subtracted from the carrying amount of the debt and shown net on the statement of financial position. You can disclose those costs in the notes, but they should no longer be presented as a prepaid or a deferred charge. Funds held for others, if organizations have a substantial amount of agency funds, the assets and liabilities, if the cash is segregated in the asset side, the funds held for others should also be segregated on the liabilities side. So it's clear that you're showing that as a separate liability if it's significant. Sometimes they're not significant, they might be grouped with other liabilities, but funds held for others, best practice should be segregated. Incorrectly using terminology, deferred revenue refers to exchange transactions under topic 606, while refundable advances refer to contributions under ASC 605. I do want to talk a little bit about leases, since this is new for not-for-profits with 12/31/22 year ends and going forward. A lot of our June 30th year ends are implementing or issuing financial statements with topic 842 implemented for the first time. So some reminders here: your operating and finance right of use assets cannot be in the same line together. They need to be apart from each other. Likewise, operating and finance lease liabilities cannot be in the same line together. You can't group all of your ROU assets and liabilities together. Now, if operating and finance ROU assets and the lease liabilities are not presented in their own separate lines, so for instance, if your finance ROU assets are included in property and equipment, your footnotes need to disclose which line item in the statement of financial position includes that ROU asset. Likewise, if your lease liability is commingled with other liabilities in the statement of financial position, you need to be disclosing them. Just keep in mind, it's allowable to group like capital lease. What were capital leases are now finance leases. So if you have those grouped with property and equipment, that's okay, but you have to disclose it. And you need to make sure that you're not also grouping the operating assets there. They can't be in that same line. So best practice, if you've got significant leases, you want to be presenting those ROU assets and lease liabilities for operating leases separately from other assets and liabilities. Likewise, the ROU assets and liabilities for finance leases separate from other assets and liabilities. And then lastly, I have seen this where the ROU assets and liabilities upon implementation are the same. It's at year end and the amounts net, and so the preparer has just forgotten to put the ROU assets and liabilities on the statement of financial position at all. So we want to make sure we're including the ROU assets and liabilities, adding those lines in the statement of financial position, making sure those new line items are also in the proper order of liquidity. Net assets, where we find some issues in financial statements, are the board designations of net assets are not properly reflected either in the statement of financial position or properly disclosed in the notes. So your board designations are designations of net assets without donor restrictions, but they're subject to self-imposed limits set by the board. They could be for investment, endowment, contingencies or rainy day funds, purchase of construction of fixed assets, or other uses. So we want to make sure that we're disclosing the nature and amounts of board designated net assets, either on the face of the statement of financial position or in the notes. And then sometimes you'll see within net assets without donor restrictions, an amount that's board designated, but then that board designation creates a negative amount of unrestricted or without restriction net assets. So that doesn't really make sense if you're showing a negative amount of without donor restrictions that's not designated by the board of directors, because that would indicate there are not sufficient assets available to designate. So you can't designate something you don't have. So make sure there are sufficient assets available that those board designations can be funded. All right, now we're going to move on to the statement of activities. The statement of activities, there's a lot of flexibility within the presentation of the statement of activities. However, there are some required elements. You're required to present some key totals, the change in net assets without donor restrictions, with donor restrictions, and the total change in net assets. A common error here, if the not-for-profit has no net assets with donor restrictions, no activity for it during the year, you still want to indicate on the statement of activities that the activity is all without donor restrictions. So an appropriate caption should be used in that case. Not-for-profits can have either a single step or a multiple step format of their statement of activities in a single column or multiple columns. I'll give an example of what that looks like on the next slide. Comparative statements are recommended by FASB, but aren't required. And summarized comparative information is allowed but not required. And I'll talk about special requirements for summarized comparative information when we get to the notes. So here's an example from FASB about that multiple column format. You can see all of the activities that are flowing through without donor restrictions are in that first column, and then the activities with donor restrictions are in the second column. And you'll see right before total revenue, gains, and other support, the net assets released from restrictions, and that amount should net to zero. Where we get into trouble is the other format that's available is to list a single column, and you'd have all of your activities without donor restrictions first in a subtotal, and then all of your activities with donor restrictions following that in a subtotal. And when the net assets released from restrictions aren't being presented in that same line, it's easier to make an error where they don't net to zero. So just wanted to point that out while we're looking at this example. So I want to go into some more detail of what the common errors are in the statement of activities, and a lot of it revolves around contributions. So as a refresher, not-for-profits have a couple options for when contributions with donor restrictions are satisfied in the same period, when those donor restrictions are met in the same period. Option 1 is to show those contributions as increases to net assets with donor restrictions, and then show them being released in the net assets released from donor restrictions. Option 2 is if the donor restrictions are met in the same period that they are received, they are shown immediately as an increase to without donor restrictions. Not-for-profits may elect a separate policy for contributions with donor restrictions that were initially conditional versus those that came in that were initially unconditional. So they don't have to choose the same for both conditional and unconditional contributions, but they need to disclose it. And then they have to elect a consistent policy for investment return that has donor restrictions that are met in the same period. So I'm going to give you an example. I took that statement of activities from the FASB codification and showed an example of what it would look like under option 1, where the activity is flowing through with donor restrictions and then being released, or option 2, where you have the amounts that have been satisfied in the same period showing up in without donor restrictions directly. So for this example, I just assumed that the contributions of cash and contributions of non-financial assets, those restrictions were all met in the same period. And the investment return, I assumed that in this example, there were some endowment funds that the funds were used in the same period, and that's why the net assets were released from restrictions. So those details weren't in the FASB example, so I took some liberties there, but that's how it would look like in the two different formats. So how do we recognize when that's wrong? We'll have some ways to indicate that your releases of restrictions would be more than your restricted net assets that you're starting with. That would be one indication if you were using this option 2 that something's not right with that option. You'll notice here in this example too that you've got contributions of cash and other financial assets separate from contributions of non-financial assets. When we go to the next slide there, this is something that is from a recently adopted accounting standard, that those contributions need to be presented separately. One other area we see it that is missed sometimes is the failure to recognize contributions of those non-financial assets in the first place, so your gift in kind. And a difficulty in measuring a gift is not a reason for not recognizing it. So even though it might be hard to value, it's still the not-for-profit's responsibility to make those fair value estimates and record the contributions of non-cash gifts if they meet the criteria. So often free or below market rent could be missed, goods and services, donated media. Consider whether you've got donated inventory at year end, whether any of those amounts should be capitalized. And also just remember that we need to separately report those non-financial assets separately from the contributed financial assets. For grants, that's the next area where we see some difficulties. And again, this goes back, like the promises to give, a lot of the difficulties here stem from underlying errors in the accounting. So errors in presentation may result if grants are improperly determined to be contribution or exchange or vice versa. So as a reminder, grants could be either contribution or exchange. You need to look to who is receiving the primary benefit of those grants and make that contribution versus exchange determination first. For grants that are under topic 606 or exchange, the codification requires those performance obligations to be satisfied to recognize revenue for the grants. And if it's determined that they are contributions, we want to make sure that any conditions have been met before recognition. So for instance, your cost reimbursement grants require expenditures to be made, matching grants require gifts to be raised, that probability threshold is gone, and only the donor imposed conditions that are administrative or trivial in nature can be ignored. If you are receiving grant funds in advance, as I mentioned, those need to be recognized as refundable grant advances. And if the measurement criteria for recognition is not met, so they shouldn't be showing up in your statement of activities until earned. And then the possibility of refund upon audit is a contingent liability that should be recognized if probable, and at a minimum disclosed it if it's reasonably possible. The not-for-profit will have to refund some of the grant funds upon audit. So common errors in the statement of activities is not following that policy for donor restrictions met in the same period or investment return. As I mentioned, net assets released from restrictions don't net to zero. You're missing required subtotals or totals for changes in net assets. Incorrectly presenting agency transactions in the statement of activities instead of just showing them in the statement of financial position. I'm going to talk about this next one a little bit more, the operating measure, improperly excluding gain or loss on disposal of property and equipment in the operating measure. The FASB does not require not-for-profits to use an operating measure. So you will see this though in some financial statements where there's revenues and expenses and there's a subtotal change in net assets from operation or net income or loss from operation, and then there'll be some non-operating activities presented below that before you get to the total change in net assets. If a not-for-profit is presenting an operating measure in the statement of activities, there are some requirements for things that need to be included in the operating measure, which are listed here, and things that should be excluded from the operating measure. The one that I most see in practice is the gain or loss on the sale of property being presented in that non-operating section in error. It needs to be, if it's from a continuing operation, it needs to be in that operating measure. So needs to be in your revenue and or expenses, not expenses, I'm sorry, losses, either in your gains or losses. So either in the revenue section, or if you're presenting a statement of activities that have expenses and losses, it would belong in the losses section. Most often it's presented in the revenue section for your gain or loss on disposal. So expenses and losses in the statement of activities, you may present a mixture of natural and functional expense classifications in the statement of activities. But if you're doing that, you need to present a statement of functional expenses or disclose that analysis of expenses by nature and function in the footnotes. Expenses need to be reported as decreases in net assets without donor restrictions. You can have losses in net assets with donor restrictions, but you can't have expenses in net assets with donor restrictions. And then, as I had a tongue twister there, losses do need to be in losses, not in expenses. So your loss on sale of property and equipment doesn't go in expenses in the statement of activities. It doesn't go in your statement of functional expenses. It just belongs in the statement of activities as a gain or loss. Other common errors, inappropriate accounting for investment return as without donor restrictions, if there really were donor restrictions on that return and gains, or improperly releasing net assets from restrictions at the wrong time. So either before the donor restrictions were satisfied or after they were satisfied because you've squirreled them away. So the timing of releasing assets with donor restrictions, net assets with donor restrictions, is a common error that we see. Time restrictions on gifts of long-lived assets. Those time restrictions generally expire when the constructed long-lived assets are placed into service. Unless the donor has specified something else, that would be the appropriate time to release them. And then revenues from exchange transactions should be reported as without donor restrictions. That doesn't go in with donor restrictions because it's not a contribution, it's an exchange transaction. All right, we're about halfway through, so your second code word is 343. Go ahead and put that into Conferences.io for your CPE credit. Again, the code word is 343. All right, next we're going to move on to the analysis of expenses by nature and function. The requirement is all not-for-profits need to report information about all expenses in one location by nature and function, either on the face of the statement of activities, as a schedule in the notes, or the separate statement of functional expenses. This is to help donors, creditors, and others in assessing the service efforts. So in the FASB codification, they give an example here, either in the notes or the statement of functional expenses. These are the two most commonly seen presentations, although you could, for a less complex presentation of the statement of activities, let's say you don't have a lot of programs, maybe you have one program, maybe you don't have a lot of supporting service categories, you may present this information on the statement of activities. It just tends to become a little busy, so most not-for-profits choose to present a statement of functional expenses or put this information in the notes. You can see here you've got your natural classifications as the rows and your program and supporting services as the columns. Where we see some problems in practice are in segregating the natural and functional classifications, which I'll cover in a minute. So your functional expense categories, your program expenses are those directly associated with the not-for-profit's mission. Management in general are those costs incurred to run the not-for-profit. Fundraising are the activities undertaken to induce donors to contribute money, services, or other assets. And then some member organizations may have a separate department for member development. Some of them may choose to include that in another supporting service category. So your analysis of nature and function, there are instances where you have to allocate expenses across different categories because it benefits more than one program or supporting service. So there are a few different methodologies there. The first one is to use salary-based allocations, to use employee timesheets to allocate expenses or time studies, other estimates of time spent. You could use square footage to allocate expenses to the respective programs. You may have another rational system and systematic basis, for instance, usage of number of copies used for allocation of a copy machine or other kinds of usage based allocations. And then there's direct, where you can specifically identify the expense and charge it right to the respective program or supporting service. So just keep that in mind, because allocations is a lot of times where errors are made, where things are allocated that shouldn't be, or vice versa. Common errors in the statement of functional expenses or equivalent are errors agreeing to other statements or disclosures. So for instance, depreciation expense presented in your analysis of expenses doesn't equal depreciation expense on the cash statement of cash flows or in the notes. Missing expenses that were netted on the statement of activities. The requirement is all expenses in the statement of activities, except for investment expenses, which are required to be netted with investment return, need to be on that statement of functional expenses or equivalent. So if you have costs of goods sold that are netted in your revenue section on the statement of activities, you need to add those back in the statement of functional expenses and put them in the correct program or supporting service that they belong with. A lot of not-for-profits will show a subtotal on that statement of functional expenses or equivalent that has total expenses as presented on the statement of activities, and then they'll add rows underneath that to show cost of goods sold or cost of direct benefits to donors that had been netted in the statement of activities, and then show a grand total of functional expenses. So you still have a subtotal that will agree to the statement of activities. So that's one way you might choose to do that. Another common error is including losses or equity transactions as part of expenses, including investment expenses instead of netting with the investment return. I mentioned that's the one exception. Those investment expenses need to be netted with the return. The breakdown of programs on the statement of activities is different from that on the statement of functional expenses. Those should be the same, and the programs need to be disaggregated sufficiently. Other errors are occupancy or facilities costs being presented as a separate program. FASB codification says that's not allowed. Your occupancy and facility costs are to be allocated among the program and supporting services benefited. Other errors are having inadequate or improper natural expense classifications. So for instance, you shouldn't see a natural expense line item called fundraising. Well, you've got a function called fundraising. So your natural classifications should be what fundraising costs did you incur? Was it salaries? Was it supplies? Was it rental of facilities? Was it mailing costs? So those natural expense classifications need to make sense, and there need to be, they shouldn't be describing things that aren't commonly understood. So if you have a natural expense classification that an outside reader isn't going to understand, you probably should consider whether that's an appropriate natural expense classification. Other errors are in allocations. So expenses that the codification says should remain in management in general, like audit, accounting, payroll processing, HR functions, advertising for exchange transactions, those should stay in management in general and not be allocated. On the flip side, GAAP also says you can allocate out depreciation, interest, other things that benefit more than one functional expense category. So those should be allocated as appropriate. Oftentimes you'll see expenses that look like they're allocated without an apparently reasonable methodology. For instance, everything is allocated out 50-50 to program and management in general. Well, think about the not-for-profits organization and operations. Is that really correct? If you read in the notes that there are several different programs that are doing very different things, is it really appropriate to allocate to cost to them 50-50, or should it be on some other basis of allocation? And then if you look at supporting services columns and they have salary costs, but they don't have any occupancy or utilities or insurance or other things that would it be expected to support those individuals? Have we missed allocations? So think about the reasonableness of costs that would follow salary costs. Are they there? Should they be? Is that appropriate? All right, next we're going to go to the statement of cash flows. Not-for-profits may use the direct or indirect method. As a reminder, not-for-profits that choose to use the direct method get an out that for-profit organizations don't have. Not-for-profits don't have to present that section of adjustments that reconcile the change in net assets to operating cash flows. They get out of doing that. So if you have that in your statements, it's not wrong, but that part's not required anymore. Not-for-profits are, however, required to present the change in cash, cash equivalents, and restricted cash equivalents. And the issue here is GAAP does not define restricted cash. So the not-for-profit needs to determine what is considered restricted cash and properly include that in the statement of cash flows and properly disclose it. And if the not-for-profit has amounts that are presented as cash and cash equivalents and restricted cash equivalents separately in the statement of financial position, there needs to be a reconciliation shown between the amounts presented in the statement of financial position and on the statement of cash flows, either in the statement at the bottom of the statement or in the notes to the financial statements. So some examples of restricted cash and cash equivalents could be donor restricted funds, for instance, those that are restricted to the purchase of endowments or long-lived assets, deposits, security deposits, escrows, amounts required to be set aside for debt service, amounts required to be held when the not-for-profit is the trustee of a charitable trust or split interest gift. So those are just some examples. So just keep in mind, the statement of cash flows uses restricted cash with a broader meaning than just donor restricted cash. I do want to talk a little bit about topic 842's effect on the statement of cash flows, because again, we're seeing financial statements being prepared for the first time with topic 842, and there is some confusion sometimes about where those payments go on the statement of cash flows for leases. So your principal payments on finance leases are still going to go in the finance section, same as capital leases were before. Payments on operating leases that are necessary to bring the right of use asset to their necessary condition are investing. Ongoing payments on operating leases are operating. Your variable and short-term lease payments that aren't included in that lease liability are operating cash flows, and then interest on finance leases follows the requirements of ASC 230. So just make sure you're putting your activities for leases in the proper place in the statement of cash flows. You're not just going to see a line in the changes in assets and liabilities like you do for other, like accounts receivable and payable. Leases have their own requirements for presenting those activities in the statement of cash flows. Common errors on the statement of cash flows, signs are reversed, so gains and losses, you see this sometimes. Captions don't agree to the corresponding captions on the statement of financial position, the statement of activities, the statement of functional expenses, or the footnote disclosure, so watch what you're calling things. Amounts not agreeing to corresponding amounts. For instance, your adjustment for bad debt expense on the statement of cash flows doesn't match your bad debt expense line item on the statement of functional expenses. Cash received and paid in agency transactions are cash flows from operating activities. So those could be presented gross or net, but they still belong in operating activities. Other common errors are failure to properly report operating adjustments. So I mentioned bad debt expense, that should be its own adjustment in the operating section of the statement of cash flows, not just netted in with the change in accounts receivable. Gains or losses on the disposition of fixed assets are adjustments to the operating section, and then proceeds from the sale go into the investing cash flow section. Other errors are contributions of new split interest agreements are also operating adjustments, as are the change in value of split interest obligations. Other common errors, contributions for long-term investment or fixed assets need to be adjusted out of the operating section and then put back into financing inflows. Those are intended to support the purchase of investments, purchase of fixed assets, so those need to be adjusted out of operations. So the amount that you're adjusting out of operations is going to be that accrual number that's in your statement of activities as a contribution, and then any actual cash received goes into the financing section, and that number may not be the same amount if you've got promises to give or contributions receivable for those purposes. So that difference would be flowing through the change in contributions receivable. So let's say you got $50,000 to invest in the purchase of fixed assets, and that's the accrual number. You would subtract $50,000, and let's say the donor only paid you $25,000 on that pledge or promise to give. You'd show $50,000 coming out of operating, $25,000 coming in as a cash financing inflow, and that other $25,000 would be included in the change in contributions receivable. So just be mindful of that if you've got adjustments for long-term purposes. In the investing activities, purchase of fixed assets should be cash purchases, not accrual-based purchases. You may have a non-cash item to disclose if you've got purchases of fixed assets that are included in accounts payable. Netting purchases, abandonments, and sales of fixed assets with purchases is another common error. Those need to be gross. Cash inflows for sales proceeds from long-lived assets need to be shown as an investing cash flow, and netting the purchases and sales of investments is incorrect. Those also need to be reported gross. Financing activities, again, there's some netting issues that we see errors, particularly with draws and payments on the line of credit. If that line of credit has an original maturity of more than 3 months, you need to be showing those draws and repayments gross, even if the line of credit was paid off at year end. And then debt issuance costs are a financing cash outflow, just a reminder there. And then non-cash investing and financing activities are things that are often overlooked, but you need to be disclosing information about those non-cash investing and financing activities, particularly non-cash gifts, purchases of fixed assets in accounts payable, obtaining lease liabilities and ROU assets. So when you first get that ROU asset and lease liability on the books, that's a non-cash transaction, so that needs to be disclosed. And then also disclosing debt incurred while acquiring assets. Other missing disclosures that we sometimes see are income taxes paid and interest paid, and incorrectly reporting the amounts of interest paid, whether it's including interest expense instead of cash paid for interest, or incorrectly including capitalized interest in cash paid for interest. So next, we're going to move to the disclosures. Some often missed disclosures. I mentioned that not-for-profits are not required to present an operating measure in the statement of activities, but if they do, you need to be disclosing what is in that operating measure and what's outside of the operating measure if it's not clear from the titles in the financial statements, in the statement of activities. So if you can't clearly tell, or if there's multiple line items called the same thing in operating and non-operating, you need to make that disclosure of what is considered within the operating measure and what's without. If I mentioned again, not-for-profits are not required to present comparative financial statements. They have an option to present summarized comparative information. And if they're doing so, there's a required disclosure that needs to be in the notes saying that the financial statements contain summarized comparative information. It's not enough to constitute a full presentation in accordance with GAAP. And the reader should look at the prior year financial statements in connection with the current year to have all of the required information. Another frequently missed disclosure is the use of estimates. Not-for-profits are required to disclose that the financial statements contain estimates. The accounting policy for what is considered restricted cash and cash equivalents, or what is excluded from cash and cash equivalents. I mentioned cash held temporarily in endowment before suitable investments are identified should be included in investments, not cash. So your cash and cash equivalents accounting policy should state that. The accounting policy should also state what's considered restricted cash if you're presenting those lines on the statement of financial position. Disclosure of your accounting policy for contributions with donor restrictions and investment return with donor restrictions where the restrictions are met in the same period. That accounting policy election should be disclosed for all of your applicable revenue streams. As I mentioned it before, you can have a separate election for amounts that were initially conditional. So if you're choosing a policy for that, disclose that too, because it might not be the same policy for those contributions that were initially unconditional. With the topic 606 being implemented, we sometimes see some missing or incomplete disclosures around topic 606. So your beginning balances of contract assets and liabilities for each year presented. So if you're presenting single year financial statements, you are showing the ending balance on the statement of financial position, but then you still need to disclose the beginning balance, which wouldn't be presented. And same for comparative statements. We often see that you're missing the beginning balance of the earliest year being presented in the statements. Another frequently missed disclosure is your measure of progress. So the input or the output method that you're using on revenue recognized over time in accordance with topic 606. So you need to make sure that your qualitative disclosures are describing the measure of progress you're using to recognize revenue over time. Concentrations of risk are often missed. So for instance, concentrations with major customers, donors, geographic areas, uninsured cash. That's particularly relevant in light of bank failures in the past year. So your cash in excess of FDIC insurance should be disclosed. Outstanding purchase commitments. So if you have non-cancelable purchase commitments, so contracts over 1 year where there's a penalty or non-cancelable provision in that contract, you should be disclosing those outstanding purchase commitments, including construction commitments. Related party transactions, we often see that those are missed. Sometimes the rationale is that they're immaterial, but while they may be immaterial from a quantitative standpoint, they may not be immaterial to a reader from a qualitative standpoint. So make sure you're thinking about whether you've appropriately disclosed related party transactions. For those not-for-profits that have endowments, disclosure of underwater endowment funds, that was a relatively new requirement. You're required to disclose the original amount of the amount to be held in perpetuity, the current balance, and the deficient amount that's within net assets with donor restrictions. The liquidity note. What happens if we have a negative amount of available financial resources in the liquidity note? First thing to do is check to make sure you didn't double count something. So for instance, you've listed all of your financial assets, then you've subtracted investments that are restricted to endowment, but you also subtracted total net assets with donor restrictions. So you've double counted those investments restricted to endowments. So check that you haven't double counted anything. Check for donor stipulations that restrict non-financial assets. So let's say your net assets with donor restrictions include restrictions for construction of a building. So you've subtracted all of the restricted net assets from your financial assets, but really some of that amount that's restricted for construction of a building is sitting in construction in progress. So you've subtracted too much because you don't have construction in progress in the numerator, so you should not be subtracting it in the net assets with donor restrictions in the denominator. You should be using a lesser amount of net assets with donor restrictions to subtract out. Check for other resources that the not-for-profit might have. Are there available lines of credit or quasi-endowments that the not-for-profit could use to satisfy its liquidity needs? And then if you go through all of that and the not-for-profit still does not have enough liquid resources to satisfy expenses in the next year, you need to determine if the not-for-profit has maintained enough assets to comply with all of its donor restrictions. And if the not-for-profit has inappropriately or because the market value of investments crashed or whatever the reason is, if there's not enough assets to satisfy the net assets with donor restrictions, the amounts and circumstances should be disclosed. I'm going to skip over some of these because we're coming up on time.
Yeah, I know.
But just as a reminder, we've got accounts and notes receivable have required disclosures. There's some common errors in investment disclosures where we're seeing things not in the right place in the hierarchy. There are some inadequate disclosures on donor imposed restrictions. We want to make sure that we're giving full and complete transparent information on net assets with donor imposed restrictions in the notes. And then I talked a little bit about gifts in kind, about making sure that those are properly recognized. I did give a sample footnote policy here on functional expenses. The thing in bold is just to tell you that expenses that are allocated need to be enumerated, what those are in the disclosure and the basis for allocation. I put in another slide here for leases because that's new. Just make sure that your transition policy has all of the common elements, and then the additional new disclosure requirements have been addressed in your footnote. So I want to give you the last code word before we have to end the call. So you've got that. The last code word is 590. 590. And then just as a final review, make sure all of your accounting policies are properly disclosed, reviewed every year. Give those financial statements an overall review to make sure that you as a reader understand them, because if you don't understand them, then an external reader is likely not going to understand them either. And with that, I think we're a little bit beyond our time, so I apologize for the delay. I'm sure we've had questions that have come in during the presentation, so I will do my best to answer those all timely for you. I want to make sure you get your questions answered. And I want to thank you for your time this morning and hope that you learned something new about what errors that are seen in practice and how to avoid them.
Yes, thank you, Jennifer. I think that was a wonderful presentation full of lots of content and lots of things for everyone to consider. Again, thank you everyone for joining us. Please feel free to submit questions along with your evaluation to get that CP, and we'll make sure to follow up. So again, thank you for joining. I hope everyone has a great rest of your day.
Thank you.